Good morning, everyone, and thank you for joining us for today's quarterly market investment updates. This webinar is going to be a 1-hour session hosted by May Barnhart Investments, and our presenters today are Gregory Estes, Stephanie Anderson, and Josh Hahn. For those of you who are new to MBI, we'd like to welcome you. MBI is a fee-only wealth management advisory firm that offers comprehensive financial planning and customized investment management services. MBI also hosts these complimentary market updates on a quarterly basis to, just demonstrate how you could benefit from collaborating with one of our professionals. So what they take you through today, for example, is going to be the kind of work they use to support our clients. We'd also like to offer you the opportunity for a complimentary consultation. So if we feel your situation could benefit from our expertise, I'll drop a link to a short evaluation form in the chat box close to the end of this webinar, asking you to evaluate the session. It's very short, but that's where you could provide an opportunity to say, yes, I'd like to be reached out to about a consultation. And it's a very short survey too. It only takes a minute to finish. For those of you who submitted questions during the registration process, those have been sent to our presenters. So, they've gotten ready responses to respond to you. But if anything comes up during the webinar, please use the chat box. That's also being monitored. We want to make sure that we answer any questions that you might have. For those of you who've been with us before, something we're doing that's a little bit new this time is during Stephanie's component of the webinar, there's going to be a couple of polling questions asking you about retirement planning and estate planning. So that's new. We're trying to enhance audience engagement. So if you could participate, I would also love your feedback on whether you think it works for this format as well. And then just finally, before I introduce the speakers, the session is being recorded, and a copy of the recording and the slides will be sent to you within the next day or two. So let me just read brief bios for our presenters now, and then I'm going to turn it over to them. Gregory Estes is a senior portfolio and relationship manager at MBI who has nearly 30 years of building successful client relationships, managing portfolios, developing client investment strategies, performing equity research, and leading compliance-based risk management strategies. He helps oversee the wealth management goals of MBI's high net worth clients by cultivating relationships and providing customized research, analysis, and informed guidance. He's also a chartered financial analyst, which is one of the industry's highest distinctions in the investment management profession. Stephanie Anderson is a manager of financial planning and wealth management. She has more than 30 years of experience in investment management and strategy consulting. She helps clients make smart financial decisions and confidently navigate all of life's transitions to achieve their life goals. She works with individuals, couples, and families to manage their finances in a comprehensive, holistic manner, from marriage, starting a family, navigating a divorce, planning for taxes, preparing for retirement, and estate planning and legacy planning services. She's also a CFA charter holder, a CFP professional, and a certified divorce financial analyst. Josh Hahn is a portfolio manager with MBI. He has more than 10 years of financial service expertise, including in the areas of fixed income, alternative assets, and consulting for institutional and private clients, and asset liability modeling. Josh works with clients to review their portfolio risks and performance outcomes set against benchmarks, analyzes model equity and fixed income funds for client portfolios, and he assists in other areas of financial planning. Once again, I'd like to welcome you, and I will turn this over now to our presenters.
Well, thank you, Joe, for that great introduction. So I'm Greg Estes, and I'm really pleased to be with you on behalf of Stephanie and Josh. I know we all appreciate you guys making time in your busy days to join us. We are going to be doing something a little bit different than the last time when we did the quarterly market update. So we are going to start with, kind of the broad picture of the economy and what's going on with rates, and then moving down, if you think of it as a funnel, down to something more specific in market fundamentals and what's going on inside the markets. Josh is going to get a little bit deeper into equity markets and fixed income markets, as well as he's going to share some thoughts he has about the election and its impact on markets. And then we are going to have Stephanie, who is going to conduct a financial plan check-in. And that is, something of, I think that would be of great interest to a lot of our participants and how you're doing mid-year on your financial planning. So when I saw this cartoon, my first thought went to if you remember that show from the 1990s, The X-Files, where you had this odd couple, FBI agents Mulder and Scully, investigating paranormal, legendary activity and conspiracy theorists. And Agent Mulder was sort of the believer in all of these things, and Agent Scully was more of the scientific skeptic. Um, I kind of wonder if Scully would be telling us, well, you keep talking about something that there hasn't been a sighting of it. You know what we call people like that who swears something's going to happen and it never does? You call that person a nut. Well, all kidding aside, the financial media, economists, the market itself, a lot of the participants have been talking about rate cuts. When are those rate cuts going to happen? It's been a very hot topic, and it's really been influenced by the data that the Federal Reserve has received as far as how the economy is performing, how the labor market is performing, how inflation numbers are reading, and you know if I were to say when they're going to happen, it's going to happen sooner now than you might think. So let's talk about where the economy is today. The chart on the left is going to show you quarterly economic growth. Um, you know, this has come down from where it had been in previous years. It's growing at kind of a stable, lower, but still positive rate. The most recent quarterly snapshot was a 1.6% growth rate. Economists are forecasting something kind of in line with that going forward. So positive growth, but not fantastic growth. But that's kind of where we would expect the economy to be growing when I'm talking about rates here, I'm talking about the federal funds rate has been elevated since last July at about 5.5%. So that's a fairly high rate for the Fed funds rate. So it does kind of put the brake on the economy, but nonetheless, the economy's been pretty resilient. If you look at purchasing managers' activity, the chart on the right, this is kind of looking inside companies at the people responsible for purchasing raw materials or supplies that go into their business and asking them about their activity level. And it distills this information into a composite reading so that anything above 50 is considered expansionary, anything below 50 is contraction. And you can see both manufacturing output and services business activity are both, above 50, so that the composite reading is kind of in that 55 range. So, from a corporate perspective, activity is still fairly robust. These are positive signs for the economy. Um, the labor market, which has been, shown a lot of strength in the past couple of years, has finally started to cool a little bit. So the chart on the left is just showing you hourly and weekly earnings and how those look. They've been trending down. They were very strong, a couple of years ago, but they finally started to trend down. In addition to that, unemployment has started to move up. So unemployment kind of skittered on this really low level in 2023. It's still at a low level from a historical perspective at 4.1%. But if you think about it as a 12-month rate of change, it's actually picked up quite a bit. So this is something that the Federal Reserve is going to pay attention to, because what you don't want to have happen is you don't want to maintain high rates for an extended period of time and see that unemployment rate move up at an increasing rate, because the labor market is very sensitive, and as the labor market goes, the economy goes. So the Federal Reserve is going to be talking more about balanced risks. Previously, they've been talking about the risks to the economy in cutting rates too soon and keeping inflation too high. That would be one risk. The other risk is not cutting rates soon enough and pushing the economy down and pushing the economy towards a recession. So now they're talking about more balanced risks there. I did want to share one chart about the labor market. This is looking at non-farm payrolls, how many jobs are created in the economy. The chart on the left is the most recent chart. It shows you that in June, 206,000 jobs were created. Again, about 200,000 is kind of a solid, not great number. You can look at the chart to the right, which was the previous month, and it shows you a May jobs created of 272,000 jobs. Now, why am I showing you last month's chart? Well, if you go back and look at the chart on the left, the June number, the most recent one, is highlighted in purple, but the one next to it is the May number that had been reported at 272,000. But if you look at it on the chart on the left, it's showing something just north of 200,000 jobs. In other words, it got revised down. And we've seen this pattern over the past several months where the jobs number comes out and the headline number looks really fantastic and looks really impressive, and then it gets revised down. So again, we have to be cognizant that the labor market can be very sensitive and is a bellwether for the economy as far as which direction the economy is moving in. Really quickly, inflation is moderating. So showing you two different inflation readings, CPI, the Consumer Price Index in yellow, personal consumption expenditures in red. They're both moving down. They're trending in the right direction towards a more long-term target of 2%. You can see the Fed has not cut rates yet. But if this data keeps moving in this direction, it does provide more impetus for the Fed to want to cut rates. So what are the possibilities for rate cuts? Well, the chart on the left, that's a 10-year treasury, which, as it moves up, it's the market basically saying, well, rates might stay higher for longer. And you can see they started below 4% at the beginning of the year. They moved up to a peak of around 4.7%. Now they've started to trend back down. That's kind of a read that the market's starting to internalize the idea that rates are going to go down. Likewise, the chart on the right is telling you that the probability of rates being a full percent lower by March 2025 went from almost 100% at the beginning of the year to almost 0% by May, but now it's started to creep back up. So the market is starting to reassess when those rate cuts are going to happen and seeing that they might be happening sooner rather than later. Okay, I do want to show you how the stock market has been doing this year. And I've broken it up by different tranches. So we have large caps, that's the blue. The mid caps are red. The green are small cap stocks, and purple is everything outside the US. So everything starts at 0 at the beginning of the year. And what you can see clearly is that large caps started outperforming as we moved into the year, with small caps being rather moribund for most of this period of time. A lot of the narrative behind this was, well, rates have stayed elevated, and so companies that are more reliant on borrowing, such as small cap companies, this hurts their bottom line, so we're going to avoid those stocks. And that's partially true, but as I'll show you on the next slide, it doesn't capture everything about what's going on in the market. But you can see in recent history that this has started to change dramatically. So with the idea that we might be getting close to rate cuts, these small cap stocks and these mid cap stocks are moving up. But I don't think rate cuts fully encompass what's happening here. I think there's also this kind of crowded trade into the very largest of large cap companies. So what I want you to think about here and what I want to show you is the chart on the left is breaking out the performance in the second quarter of 2024, large caps, mid caps, and small caps, but then it's also breaking them out by which companies in those groups are cash rich, have a lot of cash on their balance sheet, which companies are cash strapped, and which companies are in a precarious position. And you can see that only cash rich large cap stocks actually had positive performance in 2024, whereas cash rich mid caps and small caps, they have plenty of cash on their balance sheet. They don't rely on borrowing, and yet they still didn't perform well. That tells me that more and more investors are crowding into the biggest companies out there, these large tech companies. And the chart on the right kind of shows you this. So as a percentage of the total earnings generated in the S&P 500, the top 10 companies have typically accounted for around 20% of those earnings. And it's moved up a little bit. It's moved up to about 24% of the S&P 500's total earnings. And yet, as a percentage of total market cap, those same 10 stocks are now worth about 38% of the total S&P 500. So the earnings are moving up, but market cap's moving up a lot faster. And that tells me that it's becoming more of a crowded trade. It's something to be cognizant of, that you don't want to be overly invested in large caps. They've done well, but you want to maintain discipline in being diversified in mid and small cap stocks. My final slide is really just looking at, and I want to check in on this because the idea of growth versus value stocks. And what this chart is doing is giving you a nice, easy measurement of how much more expensive growth stocks are versus value stocks. They're always more expensive, but sometimes they're more expensive than others. And right now, the basket of growth stocks out there is significantly more expensive than the basket of value stocks. And that kind of makes sense. And not to steal Josh's thunder, as he's going to show this on the next slide, but the idea that growth has outperformed value, nobody questions that over the last year or two. The question really becomes, can this continue on, or is it also time to think about maybe rotating some of your growth positioning to something more core or more value oriented? And with that, I'm going to turn it over to Josh.
All right, thanks, Greg, for teeing that up for me. So just to continue on this discussion of equities, on the screen here, we're sharing the performance of domestic equities, so non-international, over the past 3 years. Each of these blocks is a different year, with the current year-to-date metrics being on the left. Last year, we saw growth across all sizes and styles, as Greg mentioned, and in particular, we saw the most rapid rise in the large cap growth stocks, and that's indicated by the large green block in the middle square here. As Greg mentioned, it's concentrated in these large tech companies like NVIDIA, like Meta. It's not surprising if you have these in your portfolios. You've seen very good performance, in particular over the last year and a half. But this was a bounce back from 2022's poor performance when interest rate hikes were in full effect, to a scenario now where market participants perhaps saw light at the end of the tunnel, one where interest rate cuts might be in the near future. And for the first 6 months, 2024 saw a continuation of that trend. This chart is only through July 1st, so there's been a few changes that we'll discuss shortly, that Greg also brought up. But even though monetary policy hasn't totally loosened yet, we are getting signals from the Fed that the cut might be coming in September. It's definite possibility, and the upcoming election also complicates this a little bit, and we'll also touch on that shortly. Alternatively, we saw up until the beginning of this month, small caps and small cap value in particular have had the smallest gains over this time period. And as of July 1st, those small cap value stocks have had the worst performance year to date. So on the next slide, we're going to have performance year to date, not ranked by size and style, but by the sector. At the top of the list is information technology, which should not come as a shock based on what we just discussed about large growth being the best performance year to date. The communication services sector, which also contains a lot of large tech companies, also has performed above the S&P 500 performance year to date. You can see that the average S&P performance is that third row, so that the first two categories are really bringing up that average. Meanwhile, we've seen real estate has had some of the lowest gains, barely breaking even. Real estate really does relatively well in high inflation environments, believe it or not, because the assets tied to the appreciating piece of property, one, and then two, they also tend to be hurt by rising interest rates because they affect mortgage rates, which affect housing demand. Higher interest rates can also make sectors with relatively larger dividends less attractive. So that can include the financial sector and utilities, which tend to pay out larger dividends than other sectors, but both seem to be performing moderately well as of the beginning of the month. So on the next slide, much of these market movements have been in response to the current monetary policy over the past year and a half of increasing interest rates and subsequently waiting for these rate cut changes, right? But over the past year, inflation data measured by CPI, that's a very common way to measure inflation, has been lower, but not necessarily exactly where the Fed would like to see it. The CPI reading in June came in well under expectations at minus 0.1% month over month versus the expected 0.1 increase month over month. That seems like a small change, but as a month over month basis, it's quite a considerable beat. And not only that, but core CPI, which is CPI, but it strips out volatile assets like energy, like food. So it's considered a more stable metric of inflation. It also came in below expectations. This was a huge surprise and signaled a potential rate cut in September if the Fed feels like inflation is under control and markets react accordingly. So before everyone jumps on the CPI train, I'd also like to point out that PPI, which is the producer's price index, it also tracks inflation from the producer side instead of the consumer side, actually came in above expectations. So while we are talking about inflation coming in low and the Fed beating inflation, we're not necessarily out of the woods just yet. So on the next slide, what seems to be a response to these inflation numbers coming in better than expected. Over the past week, we've seen a shift in markets, and this is what Greg was talking about on his last slide. And we don't want to focus on the short term too much or make any decisions based on one week of data or very short-term momentum swings. Obviously, we do want to be paying attention to what happened and start considering whether this is an actual legitimate shift in markets, whether it's a legitimate regime change, so to speak, or if it's just a reaction to one good CPI number that could be erased by next month. So here on screen, we have a large cap product in blue and a small cap product in red. These are just for comparison purposes. And this is only data from July 11th, which is when these inflation numbers were released. And we can see a huge jump in the small cap value to 8.1% as of July 17th. There's a few reasons why small cap value may have reacted so positively to these inflation numbers, and Greg did bring this up. The differences between large cap companies and small cap companies and how much cash they have and their financing activities. When you think of large cap companies, they tend to be more cash rich than their smaller counterparts, right? So for instance, a large tech company might have a cash cow, like a search engine or a phone product that they release periodically. Those are just two big examples. And that product or that service brings them in more money than they need for expansion. They can't expand at a reasonable growth rate anymore. So they tend to invest a lot of that money into high risk, high reward ventures happening like healthcare innovation or autonomous cars that they can push cash into. And a lot of these bets don't generally pay off, but the idea is to grow a small subset that do succeed. But they can only fund so many of those projects, right? So to invest the rest, they have a substantial portion in the market or in short-term assets like cash, like T-bills, for instance. And suddenly in a high interest rate environment, they're yielding 5% and they're doing great. They're not necessarily hurting. So, and on the other hand, small cap companies are generally seen to be having more debt, more financing costs. Servicing that debt is based on interest rates. So if rates increase and your financing costs increase, you're suddenly, I think Greg phrased it as, your bottom line is affected, right? And so when this news of lower inflation, which could mean lower interest rates, came out, that's what markets were seeing in the short term. And again, this is a short-term period, and whether it's a long-term reversal or a short blip remains to be seen, but something worth considering and also a good argument for diversification among equities in your portfolio, right? Instead of just being invested in large growth stocks, there's some rationale for investing across large, small, and medium cap, as well as growth, value, and core funds as well. So on the next slide, speaking of diversification, besides equities alone, there's also diversification benefits, unsurprisingly, outside of equities, as we can see here. This black bar from the CFA Institute shows how volatile equities themselves are, meaning each of the other bars is a portfolio comprised of 30% equities and some alternative assets, so fixed income or hedge funds or commodities, right? So there's not only diversification by adding these to your portfolio so that your volatility decreases, but there's also diversification benefits between the type of fixed income, right? So cash or short-term bonds versus long-term government bonds versus broader fixed income, they all have differing levels of volatility in people's portfolios. On the next slide, I'm going to show you a few examples of fixed income and their performance and how they've been doing over the past months to kind of exemplify it's not just being diversified in fixed income, but it's also the type of asset that you're diversified in to add to your portfolio and to complement your portfolio. This is performance for T-bills, which are government bonds less than 1 year. Generally, T-bill volatility is very low. As you can see, there's very little volatility in this performance over the past year. And as long as short-term rates stay the same, that's generally how they perform. They're highly correlated with short-term interest rates, however. So if we see interest rate drops, this performance would also likely fall. And that being said, we have seen good performance over the last year relative to the overall fixed income performance. On the next slide, we're going to talk about a counterpart in high yield returns. Now, these bonds are less creditworthy than they're less creditworthy corporate securities. They tend to be short-term like T-bills, but they also tend to be more volatile, and they have to pay a higher yield to investors because they are of lower credit quality. The most interesting thing about high yield bonds is that they tend to be very correlated with equity returns, as you can see on the next slide. The high yield index is going to be in green here versus the equities that are on the red dotted line. So over the past years, as equities have performed well, so have these high yield securities. If we're looking for diversification in the portfolio, high yield funds might not be the best diversifier, but obviously could be part of a larger fixed income portfolio. On the next slide, and the final fixed income product we'll talk about is 10-year Treasury returns. These obviously have a lot longer maturity than T-bills, which mature in less than a year. So they're a lot more volatile in nature, as we've seen over the past 6 months, 12 months. If interest rates do come down, it could be very bullish for longer maturity bonds. Long-term interest rates aren't as closely correlated with the Federal Reserve target interest rate, but if yields fall across the spectrum, having long-term securities could be beneficial. Also note the performance over the past week has seen a big swing in the positive direction, like small cap stocks. If interest rates are coming down, positioning yourself for longer rates could be beneficial, provided you have enough liquidity elsewhere for your short-term needs. So with all this said, on the next slide, we have our assets quilt that we like to share periodically, and this is updated through July, so it hasn't got the last week or so of data updated in here. We like to periodically bring this up to emphasize the importance of diversification in portfolios to decrease volatility. So for example, in particular, we see international emerging markets, that's there in the red, is performing really well year to date after many consecutive years of being towards the bottom. And international emerging market is particularly interesting given China's performance over the past 6 months. And not just emerging markets, but international developed have also performed very well year to date, emerging above the middle of the pack. And commodities in yellow are also performing well after being in dead last year, losing 13.12%. So that's not necessarily talking about these asset classes in particular, but we do like to look at our portfolios as a whole and kind of look into why diversification is so beneficial to our clients. So on the next slide, We do receive a lot of questions from clients and also webinar attendees about the upcoming election, and we just wanted to briefly talk about that. Typically, questions are centered around how markets will react, and we obviously can't predict the future, and past performance isn't indicative of future results. We can't analyze the past data, and we do analyze the past data. And here, for example, we have S&P 500 returns during election years historically. And overall, we haven't seen any data particular that espouses that it's bad or generally worse to be in the market during a presidential election year. On the contrary, during those election years, we've also seen 12% returns historically. And on the next slide, just in a similar pattern, this is kind of a long-term view of presidents since the 60s. It's from the Schwab Center for Financial Research, a really great area where we do get a lot of data. And it's a great representation of the fact that as long-term investors and as value investors, thinking in the short term about performance can kind of be a fool's errand. Here we have Democratic administrations in blue and Republican administrations in red. And overall, it's just an exercise in perspective and maybe taking a larger look at how performance is maybe more correlated with other factors than necessarily the upcoming political election. It will be interesting to see if the Federal Reserve decides to cut rates in September with the election. If the Fed believes they should cut, there are questions around how can we do it without seeming political, even if it's purely based on numbers, right? People could come in and say you're doing this to favor one side or the other. For example, if he wanted to hold off until November, it might give him pause because obviously the elections are in November, and it's just definitely a precarious situation for the Federal Reserve. One final somewhat related item is that we send out our Market Bites newsletter every few weeks to a month, and in a recent one, we also have to consider that we sent this really great perspective about when markets are at all-time highs, people tend to get nervous, but in those situations, we actually see that markets continue to perform well based off of momentum, more so than when markets are more volatile. So check that out if you haven't seen it. And with that being said, I would like to pass over to Stephanie, who has a really great presentation for us and some poll numbers, and I'll hand it off.
Great, thanks, Josh. Well, it's hard to believe that we are now at the midpoint of the year. It seems like it was just yesterday that we were ringing in the new year and setting our resolutions for the year. But of course, life gets busy and hectic, and we sometimes can drift off course. As we see on the next slide, according to some research from Pew Research Center, they surveyed a number of Americans at the beginning of the year. And what we see highlighted in the middle of the screen is that about 30% of Americans said that they had made at least one New Year's resolution this year for 2024. You see some differences by age group in terms of engagement with resolutions, but overall, about 30% of Americans are making at least one New Year's resolution for the year. On the next slide, we see that most of those resolutions pertain to health and exercise or diet. But the second next topic is money or finances. About 61% of the people that Pew surveyed had set resolutions for themselves pertaining to money or finances. Now, we know from prior studies or from other studies that people tend to start the year strong and then they lose momentum with regard to resolutions as the year draws on. We also know that the people who are most successful in keeping their resolutions are people who are very specific about what goals they're trying to achieve. They write them down, and then they also put in place some sort of accountability system to keep themselves on track. We see on the next slide some data from Schwab from their 2024 Modern Wealth Survey. They looked at a variety of different Americans, and they discovered that about 36% of the people surveyed had determined their financial goals, and had also documented those goals in a formal written plan. And a majority of those people who had that written plan in place reported that they felt confident that they would reach their financial goals, and they felt more in control of their finances as a result. So on the next slide, what are we actually talking about when we talk about this mid-year review process? I've laid out really just a 4-step simple process that everyone can go through. I've done this myself and do it regularly. What are we trying to do? In short, we're just trying to make sure that we have a clear picture of where we're trying to go, the route that we're going to take to get there, and that we're assessing or sort of course correcting if needed, if we've drifted off track. Just to run around this circle, the first step, sort of the anchor point for any financial plan, is your goals. That's going to be based on your particular values, your family situation, where you are in your career, what's going on, the particulars of your specific life situation. So goals are really the starting point, the anchor point for the whole planning process and for this mid-year review process. In this instance, if you set goals at the top of the year, you would be revisiting them to make sure that they're still relevant and applicable. If you didn't set goals, mid-year is a really great time to commit those financial goals to paper as we head into the second half of the year. Second component of the mid-year review process is to assess your current situation. Here, we're primarily focused on kind of what's your cash flow situation and what's your net worth, meaning what do you own minus what do you owe. So where are you now? And then the third part of the process is to identify areas that need attention. Namely, we're looking at gaps between your current situation and what you have indicated as targeted goals and objectives. And then the fourth step in the process is to update, the route and to make sure that as you head into the second half of the year, you have a plan for how you're going to arrive at those targets. It's a little bit like when you're on a trip and your GPS, your Waze or Google Maps says, recalculating the route, there's a better way to get to your destination, or maybe a shorter way, or there's a traffic ahead. Let's take an alternate route. That's sort of what we're doing after we've assessed where we are, identified the gaps or areas that need attention. We're course correcting. This process is really one of monitoring and then repeating periodically throughout the course of the year. Taking a look at the next slide, the goal of this whole mid-year process is really to draft a written financial plan, right? So the written financial plan is composed of the 5 areas that you see laid across the screen. The first is cash flow analysis. The second is tax planning and tax strategy. The third important area is investment planning and investment strategy. Fourth is estate planning. And then finally, risk management or insurance planning is also an important consideration. So if you think of your written financial plan as being equivalent to an architectural blueprint, for example, then these 5 areas that we see laid out across the screen would be your load-bearing walls. And as we know, load-bearing walls are really important in terms of the structure, right? The viability of the structure, and also to prevent structural failures. So similarly, by shoring up these 5 areas that we see laid across the screen, you are taking steps to ensure your own financial stability, and also you're taking steps to prevent anything that could potentially derail your financial plan. So let's just take a look at each of these 5 areas in turn, starting on the left with cash flow. In each of these areas, we're going to take a look at some areas to consider and some questions to ask yourself, and then we're going to finish up with some action steps to consider. So with regard to cash flow, here, regardless of where you are in your life, in your career, it's really important to know how much money is coming in and how much money is going out for expenses. Most people have a pretty good sense of how much is coming in, right? You get a paycheck twice a month or every other week. However, a lot of folks have really only a very murky sense of how much they're actually spending. So the point of this cash flow exercise is to have a 12-month roadmap that indicates where your cash is going, to savings, to investments, to expenses, etc. It's also a process of linking back to those anchor points, to your goals. You want to make sure that you're allocating your money, your cash, in a manner that's consistent with those targeted goals that you've specified. So that's sort of the key thing. Some action steps that you could take to shore up your cash flow. First is just to do an exercise where you detail the various sources of your income, right? If you're working, that's probably from salary and bonus. If you're retired, you might have a pension, you have required minimum distributions, maybe Social Security. Just detail those sources of income. The second is to analyze your expenses. And here you can use either an online template, an app that for budgeting and spending, or you could get a more detailed worksheet from your financial planner. The point here is just to make sure that you're allocating your funds in a manner consistent with your goals. I will just pause for a moment and mention that retirement planning and education planning are kind of a subset of this overall category of cash flow planning. The sooner you start, right, the earlier you start on planning for retirement or saving for retirement and educational expenses, the better. But please note, if you are 5 to 7 years away from retirement, I would really strongly encourage you to consult with a financial advisor or a financial planner. These sort of rule of thumb or back of the envelope calculations are fine, right, if you're in your 20s or 30s, but as you get on that shorter runway to retirement, it's really important to make sure that you have a clear view on your sources of income in retirement and your potential expenses in retirement, and that you've saved enough and planned accordingly. Another area where you'd want to consult with a professional is if you're contemplating a divorce or if you're in the process of getting a divorce. These cash flow here and division of assets are really critical. So you want to make sure you have a handle on these items before you sign any documents. Otherwise, you probably, if you're comfortable with an Excel spreadsheet, you could dust it off and feel quite comfortable, running a cash flow analysis on your own. Second big area is taxes. Here, we all know that we can't escape taxes, but we want to pay our fair share of taxes and really not a penny more. So the focus here is to make sure that you're keeping track of your income throughout the course of the year, that you know what your marginal tax bracket is, and that you know how much headroom you have before you get to the top of that current marginal tax bracket. So what are some action steps that you could take here? The first is you may want to take a look at your withholdings. If you've had a bump up in income, if you've done some Roth conversions, if you are contemplating itemizing deductions, you may want to modify your withholdings or your estimated tax payments for the course of the year. Second thing you might want to take a look at is when you're in the process of rebalancing your portfolio, your investment portfolio, with regard to your taxable portfolio, your taxable investments, you may want to harvest some gains and also harvest some losses to offset those gains. Two things to keep in mind here. You want to make sure that you have given some thought to a capital gains budget or what kind of capital gains budget you're comfortable with. And also you want to make sure that you're not running afoul of any wash sale rules as you go through that rebalancing effort. Third potential action step with regard to taxes is you might want to consider doing some Roth conversions if it's likely that you're going to be in a higher tax bracket in retirement. Fourth thing that you might want to do is you may want to boost some of your pre-tax contributions. Of course, these things would serve to reduce your taxable income. Some potential areas here to evaluate would be boosting your retirement contributions at work. At a minimum, you should be contributing enough to qualify for the company match, but you may want to boost those retirement contributions. Also, don't forget about HSA contributions if you have a high deductible health plan, or FSA or dependent care contributions as well. Those would serve to reduce taxable income. Let's see, the next thing would be you might want to evaluate some sort of a bunching strategy for charitable contributions if you've typically just been claiming a standard deduction. So by bunching or combining a couple years worth of charitable donations in 1 year, you can qualify to itemize, and then you would continue with the standard deduction in off years. And then a last item to consider, if you have young people, college age children, you may want to encourage who are working this summer, right? You may want to encourage them to consider opening up a Roth IRA. It's never too soon to get started. And of course, the earlier you start, the greater the benefit from compound growth over time. So that's taxes. Next sort of load-bearing pillar is investments. And a couple of key questions to ask yourself here would be, do you have a written investment policy statement or a written asset allocation strategy? This again is to serve as an anchor point, particularly during times of market uncertainty or market turbulence. Again, just to help you to have something to come back to keep you grounded, again, in periods of turbulence. Second thing to really take a look at is, do you have appropriate diversification in your portfolio? A lot of us have different buckets of money, right? Taxable, 401k, maybe a couple of IRA rollovers from various prior jobs, but we want to make sure that we actually have diversification and not just more of the same divided up a bunch among a bunch of different buckets. We also want to make sure that you ask yourself and are really honest about your comfort level with stomaching investment risk, volatility or fluctuations in your portfolio. And then the last point is, are you implementing your investment strategy in the most cost-effective and tax-efficient manner possible, right? Some action steps to consider is to aggregate all of your investments, 401k, taxable, those IRA rollovers, and do a look-through analysis to uncover if you have any concentrations either in specific company names or specific industry sectors that would need to be attended to and over time rebalanced so that you can get more of a normal, targeted allocation. And then the last action step to consider, as we've alluded to, is to make sure that you have exposure to all of the different buckets: taxable assets, tax deferred, and tax-free accounts such as Roth. If you have this structure in place, this will give you the ability to kind of maneuver some levers in terms of generating income and managing your taxes in retirement. Of course, if you have all of your assets just in a tax-deferred bucket, once those RMDs kick in, if you haven't already done some Roth conversions, you don't have a lot of degrees of freedom in terms of managing your taxable income. Next is estate planning. We could get really fancy here, but let's just start with the basics. Do you have documents in place? That's a will, a trust, powers of attorney for financial and healthcare matters, and medical directives, advanced medical and healthcare directives. Have you updated your beneficiary designations recently? Same thing, have you updated your estate planning documents recently? In most of these documents, you're going to be notifying or indicating an executor, a successor trustee, and maybe a personal representative. Have you notified those people that they're going to be pressed into service in the event of your incapacity or your eventual death? And do they know how to find your documents when the time comes? So a couple action steps to consider here. When was the last time your documents were updated? If you have documents, take a look at them to make sure that they still reflect your wishes. If you don't have documents, this would be a great time to give a call to an estate planning attorney to set up an appointment. If your beneficiary designation forms for your 401k, those IRA rollovers, life insurance, etc., if those haven't been updated in a while, you also want to take a look at those and update those as needed. For folks who have taxable estates, meaning you're over the 13.6 million setting, or 27 million for a married couple, if you have assets in excess of those thresholds, you absolutely want to contact an estate planning attorney prior to the sunset of the Tax Cut and Job provisions that will lower those very high lifetime exemptions for estate and gift tax down to something that's more akin to the 6 to 7 million range on an inflation adjusted basis. So again, if you have a taxable estate, you absolutely want to reach out to an estate planning attorney to get something on the calendar in terms of an appointment. And lastly, for those people, again, who have college-age students at home, before they go away to college in the fall, you want to make sure that they have signed those power of attorney documents for healthcare in particular, but also potentially for finances. In the event of an emergency, for kids who are over 18, it's very important to have these POA documents in place so that parents can step in the event of an emergency to handle medical decisions. And then lastly, for risk management, this is really looking at risk that's completely separate from your investment portfolio. These are really looking at insurable events that could derail your financial plan. Premature death, disability, really outsized long-term care expenses, an illness, damage or loss of a property, etc. So here you want to chat with either your financial advisor or you want to chat with an insurance broker to make sure that you have appropriate levels of coverage in place to deal with these sorts of unknowns, again, that could potentially derail the plan. So the action steps here are to conduct an insurance review, to actually go through some calculations to determine the appropriate levels of coverage for life, for disability, for personal umbrella liability insurance, and make sure that you then take the next step to put those levels of coverage in place to the extent that you have a shortfall. And then lastly, reasonable people can disagree about the need for or the value of long-term care insurance. But what I would urge everyone to at least do is to perform an analysis, run some numbers to evaluate the potential costs of, assisted living or cognitive care for short periods of time and maybe for extended periods of time. And then to determine a plan that's appropriate for you and your family for whether you're going to self-fund these potential long-term care expenses or whether you're going to offload some of that to an insurance company by purchasing long-term care insurance of some flavor. And with that, we have sort of overviewed in a pretty quick fashion all of the load-bearing pillars of the financial planning process, this mid-year review process. And hopefully you have a couple of nuggets from this chart that you can take a look at to talk with your advisor about, your financial professional, your tax professional, or if you're handy with that Excel spreadsheet, a lot of these things you may want to tackle on your own. Critical areas, as we touched on, if you are a few years ahead of retirement, absolutely chat with someone to run the numbers and not just do back of the envelope calculations. If you're in the process of a divorce or contemplating a divorce, absolutely chat with a professional before you sign any particular documents. And then on the estate planning front, as people are out and about on planes and trains and automobiles moving about, it's of really critical importance to make sure that those estate planning documents are up to date, that your beneficiary designations are up to date. And if you have, a taxable estate that's over 13.6 million for an individual or 27.2 million for a married couple, that you make an appointment with an estate planning attorney to lock in those larger lifetime exemptions before the Tax Cut and Job Act provisions sunset at the end of 2025. And with that, I'll turn things back to Greg or to Joe.
I'll just take a quick second here to drop in the chat box a link to a survey for the webinar today. It's a short webinar, so if you wouldn't mind just taking a moment to share your thoughts on today's session, we would really appreciate it. And it'll also give you an opportunity to let us know if you'd be interested in a consult.
So I think we have 5 minutes left here. I think we have a few questions that came in before the webinar. And if anyone has any questions for our participants, myself, Greg, or Stephanie, feel free to type them in the chat box and we can take a look during this Q&A session and maybe grab some from there as well. So the first question I have here is about inflation, and we did talk about inflation during our discussion, and it asks, what's the assessment of inflation trends assuming no market disruptions? Greg, do you want to touch on that?
Sure. Well, I think inflation is, as we showed you, is trending in the right direction. You know, of course, data it can vary from month to month. I think Josh pointed out, rightfully so, that producer price index came in hotter than expected. And PPI sometimes is viewed as more of a forward look than the more common consumer price index. So, you know, everything put together, it's trending in the right direction. You know, barring, you know, some major change, it looks like higher rates have had their effect and they are bringing prices back into alignment. As I also mentioned, you know, wages themselves, which is a kind of price pressure, they're also trending in that direction. They're moving down. So that's kind of how we think of it.
Great, thanks. So we have another question here. This is about asset allocation in retirement, given market uncertainties. It's just looking for, I guess, generic advice on what an asset allocation for retirees might look like, including a cash and a T-bill proportion. You know, Stephanie, you've been working a lot with our new platform, eMoney. Is this something that you'd like to take a crack at?
Sure. I think the short answer is it depends, right? If you have a pension, for example, your asset allocation would likely look quite different from someone who doesn't have a pension, right? Who's looking at 401k or IRA RMDs and then Social Security. So that pension component, because it's pretty fixed and guaranteed, has sort of fixed income like characteristics, right? So someone with a sizable pension would probably, all other things being equal, have a lower allocation to fixed income than someone who didn't have that pension. So we want to, these sort of rules of thumb are nice, but we really want to look at the specifics of the situation. What are your sources of income? What are your expenses? And then we'll figure out an allocation that's likely to support that over the long term. Now, in terms of cash, one thing I often urge folks to do, particularly in retirement, is to have some sort of money set aside to kind of keep you grounded and to prevent you from, having a complete meltdown in the face of market volatility. Where you fall on this spectrum depends on how much of a security blanket you need to sleep well at night, right? So some people like to have 1 year's worth of living expenses set aside, maybe in T-bills, in laddered CDs, or some sort of short to intermediate fixed income, probably more shorter fixed income in that case. Some people might need 3 years. Like the most I've heard is one client who needed 7 or 8 years of living expenses in these safe and liquid investments to sleep well at night. So that's an area that really should be focused on. Where you fall on that 1 to 3 year spectrum, again, depends on how kind of anxious you are in the face of market volatility. But having that sort of security blanket will allow you to stay calm in the face of market volatility, and most importantly, not disrupt your allocation by selling in an environment where market valuations are falling.
Yeah, very, very good answer. I think we have time for one more question. So I'll hand this off to Greg. What role do you think precious metals should play in a portfolio? We didn't really talk about this today. Sometimes we do, but question from the users.
So precious metals usually are considered more of a hedge on inflation, although they do have some sort of component which is concern about like if rates have to be elevated systemically because of high spending, high debt levels, the idea of some kind of stable value. Uh, Precious metals can hold some interest there. If you have it, it really shouldn't be kind of an all-in type of approach. It should be as a component of your asset allocation, a smaller component of your asset allocation, mostly as a hedge, right? Your long-term growth generators are going to come from stocks and from riskier bonds. Uh, Precious metals are more because they fluctuate so much, are going to be more like a satellite holding within that allocation.
All right, I think with that question, that brings us to time. So thanks to our presenters, thanks Joe, and thanks for everyone for joining us. And we'll see you next quarter, our next market update. Take care.